Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in today's podcast, I'm going to talk to you about what bonds to avoid in this market. And just before that, I'm just to mention that we are having a webinar on the same topic, what bonds to avoid in this market, on the 27th of July at 4 p.m. Wednesday. Do not forget to register for the webinar at inrbonds.com, or you can click on the description in the YouTube channel if you're listening to the podcast on YouTube and register for the webinar. Do not forget to register for the webinar. And back to Let's Talk Bonds. What is Let's Talk Bonds? It's a podcast where I will take investors and financial advisors to give them a solution on which are the best fixed income options to invest for the investor for direct investments of financial advisor for their clients. And so, what are the bonds to avoid in this market? Now, the fact is that yields have gone up in the market. So, from what it was last year, yields are definitely much higher. And many investors and financial advisors are believing that maybe 3-year plus bonds are looking more attractive. And should they look to invest in such bonds? We have, for example, 2-year bonds at closer to 7%, 680 to 7%. 3-year bonds starting, NABARD is issuing a 3-year bond at 7 quarter, and 3-year other NBFC bonds are all going in a 7 quarter to 7.5 levels. We have 5-year bonds at 775. The 3-year Bharat bond ETF is around 708. And the 10-year bonds is anywhere between 7.5, which is the government bond, to 8.5 or even 9%, depending on the issuer. So should one go long? As state development loans, 10-year loans are closer to 8%, while 3 years are are around 730, 740 levels, kind of levels. So clearly, and all these bonds were trading at around 6% and much below just a year back. So clearly, there is a sharp movement upwards in yields, and the question is this attractive enough for investors to invest in? Is the market going to become stable? And should also high yield bonds, which have been delivering the best returns in the markets in the last 1 year or 2 years, outperforming all these bonds and the traditional mutual fund products by over 4 to 5% or even 6% many times. And are they also attractive enough? So let us see what are the risks that are facing these bonds. That's the way to approach what bonds to avoid in the market. So the primary risk is the risk of inflation and interest rates hikes. So given that the outlook for interest rates is not very heavy, it's not very positive, even though yields have gone up, and there is no visibility that there is stability in the markets at this point of time. So you still have high inflation, supply chain disruptions. You have government borrowing, heavy government borrowing. You have global central banks raising rates. You have geopolitical issues. You have energy prices high. You have climate change issues. So there are too many issues that are facing interest rates at this point of time. And all this are primarily driven by high inflation levels, very high government debt, and the fact that because of central banks pumping in liquidity, the corporate bond markets too saw a asset bubble where yields went down to record lows, and there was too much of leverage in the market by investors, and all that is going to has hit the market. So it's going to take a time to play out. So it's the positive outlook for interest rates is not positive, and when outlook for interest rates is not positive, then clearly what happens is that price sensitive bonds to interest rates tend to underperform. So investors would have to be, and fundraisers would have to be careful of what duration of bonds they invest in. Now, should one look at high yield bonds? High yield bonds were the most attractive bonds last year because of the fact that economies were picking up, markets were doing extremely well, equity markets, access to equity funding was good, and liquidity was very heavy. And so that drove money into high yield bonds. And now, with all that is changing, equity markets have tanked, the interest rates are going up, liquidity is coming down, and all this is also hurting the demand for high yield bonds. So liquidity is coming off in high yield bonds. They have turned extremely volatile, and when they have turned extremely volatile, the fundamentally weaker companies, and then do have a problem of servicing their debt. So investors will have to be careful of the high yield bonds as well. Coming to the private placement market, there's been a lot of private placements in the market. In the last week, we had companies like Sundaram Home Finance showing 1-2 year bonds, which are floating rate bonds. Crompton Greaves issued 2 and 3 year bonds at 740 plus levels. You have Bajaj Housing Finance issuing 3-year bonds at 765. Shriram Housing Finance issuing 3-year bonds at 8.25. You have Sudarshan Chemicals, manufacturing company, issuing 3-year bonds at 8.45. You had Manappuram issuing 3-year bonds, MIBOR linked, again a floating rate bond. So Manappuram is a gold loan company. Fullerton India, a AAA rated bond, is issuing 3-year bonds, again a floating rate bond. You had 20-year issues from some of the other companies. Then you had Kotak Mahindra showing Kotak Mahindra issuing bonds. Hero FinCorp issuing 10-year bonds at 865. Mahindra Finance issuing 10-year bonds at 820. HDFC issuing 5-year bond at 777. So 10-year bonds at 820 doesn't look attractive at all, or anything over it for such companies, because SDLs are looking more attractive at 8% levels. Hero FinCorp issuing at a 10-year bond at 865, slightly higher than others. And Canara Bank issued a perpetual bond at 5-year call at 8.25%. So lots of issues in the private placement market. So many companies are utilizing this slight stability at higher levels of yields to raise as much of money as they can, because they do believe that the rates can tighten and liquidity can also fall further. Coming back to corporate results, the first few results, not very great. A lot of margin pressures, a lot of volatility in earnings. So again, not a very great prospect for corporate bond issuers, especially in the weaker category. Thank you very much for listening in. Do not forget to download our app, Quick Invest by INR Bonds, which is gives you the best curated list of bonds with our own lot of information, our own risk rating, and easy in-app investment process for both investors and financial advisors alike. Download the app now. And do not forget to follow us on all podcast channels: YouTube, Spotify, Apple Podcasts, and Amazon Music.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.